Hello everyone. So stocks are crashing. Um, as you can see, Dow Jones is today down 313 plus points. Over last 5 days, it's been down much more. So I think in last 1 month it has been down since 36799 to 34715. Same goes with the Nasdaq and the S&P. Yep. So I wanted to discuss what's going to happen going forward. As this article says, prediction is stocks might crash 50%. And this is from Jeremy Grantham. How much lower can they go? The iconic value manager sees the S&P tumbling by nearly 50% to 2,500 from its all-time high of 4,800 just a few weeks ago. So he sees S&P going down 50%. Nasdaq Composite, which closed in a technical correction on Wednesday, down 10% from its all-time high, may sustain an even bigger correction. So for Nasdaq, he expects that it may be even more than 50%, and it's already down 10% from its all-time high. So yeah, pretty big drops are possible. But let's discuss further, if it will be this much, or will the Fed intervene much before that. Signs that Grantham has been looking at are hardly a secret. The first indication that the bursting of super bubble has begun came last February when dozens of the most speculative stocks began falling. One proxy, Cathie Wood's ARK Innovation ETF, has since tumbled by 52%. Yes, so ARK has been going down both in price and in terms of redemptions. A lot of people have been taking their money out of the Cathie Wood's ETF. A lot of speculative stocks have been going down, as some of you may be aware. The loss-making tech stocks are now down 50% on Nasdaq. Next, the Russell 2000, an index of mid-cap equities that typically outperforms in a bull market, trailed the S&P 500 in 2021. So yeah, Russell has been down. Grantham also points to the kind of crazy investor behavior indicative of a late-stage bubble. Meme stocks, buying frenzy in electrical vehicle names, the rise of nonsensical cryptocurrencies such as Dogecoin, and multi-million-dollar prices for non-fungible tokens or NFTs. However, while it has certainly become more subdued, as the following chart of the single stock option activities from Goldman shows, retail is still solidly in the market. I 100% agree with this. A lot of meme stock buying was happening last year, the GME and the AMC, and then electric vehicle, those Riviana, which have never manufactured even a single vehicle, were like had like 40 billion plus market valuations. And when nobody was visiting, nobody was watching any movies into theaters, AMC was being pumped up. So was the GameStop. And later on, GameStop actually, I think, got involved into NFCs, if I'm not mistaken. Not to mention, yeah, as he rightly points out, cryptocurrencies have been pumped and dumped. Dogecoin is these sort of coins and NFTs which have no utility have been sold for multi-billion dollars. Uh, I think a lot of these Dogecoin sort of cryptos are just scams, pump and dump scams. Very good indication actually, when in when you're in bubble, all these sort of Ponzi schemes and scams happen, and once the liquidity actually dries, all more and more such scams will come to light. I have zero doubt in my mind, and a lot of these Ponzi schemes will not only come to light, will just basically be gone overnight. The checklist for a super bubble running through its phases is now complete, and the wild rumpus can begin at any time. So he thinks that basically time has started, that this bubble is this bubble can pop and start deflating. Grantham writes, adding that when pessimism returns to markets, we face the largest potential markdown of perceived wealth in US history. I agree with that statement. It will be very painful. A lot of wealth will be basically, um, I wouldn't say lost, but will change hands, I guess is the right way to put it. It will basically transition from, uh, wherever that wealth is perceived today, it will transition from those assets to some other asset classes. Sparing no superlatives to describe what is coming, Grantham said the coming crash could rival the impact of dual collapse of Japanese stock and real estate in late 1980s with catastrophic consequences. I think it will be not just in stocks. It will be not just in stocks and real estate. I think it will be both in stocks, in real estate, in bonds, in sovereign debt. So it will be collapse of lot of things, when all said and done. It may not be immediate or imminent, but when it will happen, it will be in all these different asset classes. Not only are equities in super bubble, according to Grantham, there's also a bubble in bonds. Yep, agreed. As I just said, the broadest and most extreme, no doubt about it. Bubble ever in global real estate, and an incipient bubble in commodity prices. Now, I agree with the bonds and real estate. Bonds have been going up for last 30 plus years. Real estate is in bubble. You can see, like, um, when the prices were quite decent, the house prices to income ratios were a lot less, and now they are sky high in certain cities. And this isn't a phenomenon just in US. This is across the world. The price to income ratios are like 1 is to 10, 1 is to 12, like in Sydney and Melbourne in Australia. It's 1 is to 14 in certain scenarios in Canada, and in Shanghai and Beijing it sometimes is 1 is to 20 and 1 is to 25. I mean, complete insanity. But one place I will disagree is this commodity prices. I can show you a chart here. This is a very long-term chart of from commodity from commodity index to Dow Jones ratio from 1900 to all the way to 2020, and as you can see, commodities relative to Dow Jones are very low in prices. Now they have since gone up a bit, but not at all significant. So I think I don't quite agree with this commodity prices. I think they are not at all in any bubble territory. They are just, in fact, they are record low. They are just starting to go to revert to their mean average, and because they have been they have been down so low for this long, they will go past their mean and they will be in bubble territory eventually, but that will come much later. Even without a full reversion back to statistical trends, he calculated the losses in US alone may reach 35 trillion. Man, that's a massive number. I don't doubt that number. But I think it's probably on the lower side, because just the sheer number of money printing and debts that are in market, bonds, stocks, so on and so forth, and real estate also. This may be even on the lower side. I actually tried to dig. So this is the total asset classes in 2020. The size of asset classes. So as you can see, debt securities, it's 123.5 trillion. This is global, and that's basically bonds and stuff. This is equities, 109 trillion. Residential real estate is 258 trillion. Commercial is 32, and agricultural land is 35.4 trillion. Now I did further digging. The US makes 39% of the total global bond market, so 39% of 123 is somewhere around 48 trillion. Similarly, equities are about 38%, which is around 40 trillion. Residential real estate is about 11%. So in other words, 11% is United States. So that comes, and 27% of commercial is United States as well. Agriculture is again around 11%. So if you combine all the real estate, again it comes down to around 40 trillion. So US contribution, in other words, of this total is 48 trillion bonds, 40 trillion equities, and about 40 trillion real estate. So which comes down to around 128 trillion total wealth in bonds, equities, and real estate is from United States. And if that goes down by 35 trillion, that is massive. That is really massive. So if you do a calculation, 35 is about 27% wealth decline. I still think that's on the lower side. I believe it can get even worse. Of course, Federal Reserve will fight tooth and nail to actually not allow these bubbles from popping, but we will have to see. Now, according to Jeremy Grantham, he thinks because these bubbles will pop, there will be a scare in the market which will be deflationary, and that would address the inflation that is currently in the market, in the commodities as well as the stocks and so on and so forth, which again I don't quite agree with, and let's see what Zero Hedge has to say about that. Everything has consequences, and consequences this time may or may not include some intractable inflation. That's what Grantham writes. He don't think it's sustained. Here we disagree, and I agree with that. I think inflation will be sustained. Yes, there will be crash, one which will send deflationary shock waves around the world, but it will only prompt an even bigger rescue by the same Fed, which no longer has an alternative after it crossed the Rubicon in 2020 and bought corporate bonds and junk bond ETFs to avoid an all-out collapse in post-COVID turmoil. 100% agree with that. I think there will be a deflationary shock, and temporarily it may reduce the inflation, but that will, if at all, will be extremely temporary, because supply side disruptions may not even allow that. And that's why I'm saying temporary. So while this deflationary shock may impact the demand side and reduce that demand, but I think the supply shocks will be potentially can be significant enough that the reduction in demand is not able to help much around that. Um, and from there, as soon as those the deflationary shocks are gone, because Fed intervenes and start pumping more and more liquidity, then then the sky's the limit as far as inflation goes. So in the next crash, the Fed, whose only contribution over the past 100 years has been to make the rich richer and create an epic wealth effect bubble, will buy stocks and ETFs, transforming into the Bank of Japan before eventually it loses all credibility. But by then, stocks will be orders of magnitude higher, completely disconnected from reality and fundamentals, and trading only on quadrillions of liquidity central banks inject to preserve the Western way of life. Yep, I agree. I think that's exactly what will happen. As soon as the real question is this, the only question we will have to ask, how much of a crash can Fed weather before it capitulates? Yes, and that's the real question. How much crash will Federal Reserve allow before it actually start intervening in markets again? Well, I shouldn't say intervening in markets again, because they're continuously intervening, but I guess what I mean is intervening to the upside, not to the downside. I.e., what is the level of Fed put? We are confident that another 10 to 20% lower, which will obliterate Biden's rating and Republican avalanche in midterms, surging inflation notwithstanding, and the market will finally discover what it is looking for. Now, according to Zero Hedge, it's 10 to 20% lower. I think it could be combination of multiple cross currents. If the inflation is sustained, I think there will be very high pressure that this Fed put could be even lower, because one thing politicians don't want is to let go of the power, and in order to get themselves elected, they would rather crush the stock market than crush the people or public through inflation. So they would rather like Federal Reserve to tame the inflation than actually increase it. Now, another possibility is that both Fed and government collude, and instead of taming the inflation, they try to control the perception of inflation. So they, in other words, this number around 10 to 20% lower Fed put might be correct, but any inflation surge that will come after the intervention would be controlled through perception, i.e., through gimmicks like PCE, that they will try to control the CPI numbers or PCE numbers. So they will try to use those measures that I did a video on called trimmed PCE, where they start excluding the inflation into certain areas which doesn't follow the narrative, whether it is the food prices or the rents and so on and so forth. And that could be another option. We'll just have to see how this will go. But I strongly feel if the inflation is really high, the pushback will be so strong that the capitulation in stock market would could be even higher than what people are thinking. Anyway, those are the thoughts. The stock market has been going down significantly over last few days. It may accelerate, and if it does, then we'll just have to observe if Fed intervenes or not. Um, Thanks for listening. Please share, subscribe, like, and I will see you in the next one. Bye.